Hello everyone and welcome back to another tutorial. In this tutorial we are going to learn how to calculate amortization or depreciation using a method called the declining balance method that we talked about in class as it refers to a Ford truck that was purchased by the company. If you recall, the purchase price of the Ford truck before HST was $28,750. Again, as discussed, for accounting purposes, we are not to expense the entire amount of the asset at the time that it's purchased, but rather we spread the cost or the expense of the asset over the estimated life of the asset. The reason we do this is because we need to follow GAAP, generally accepted accounting principles, whereby we match expenses with the revenues generated. To put it another way, this Ford truck is going to generate or help the company generate revenue for several years. And as a result, we're going to spread the cost or the expense of the truck over many years. So let's get started. And before we do that, we've got, if you recall, we have the Ford truck set up as either a long-term asset or property, plant, and equipment on your balance sheet. We then added an account that was a sub-account of the Ford truck called accumulated amortization. And this account is going to keep a total of all the depreciation that we have expensed against the truck. And then finally, we'll have a line on our balance sheet that'll say total Ford truck, which is actually the net book value or NBV. This is the amount that is remaining on the vehicle that has yet to be expensed. So let's get into this and demonstrate how we calculate. Okay, so once again, we had talked a little bit about the straight line method to depreciate, but on vehicles, we're going to use a method called the depreciation method, or pardon me, actually, it's the method we're using to depreciate is called the declining balance method. So simply put, we're just going to apply a percentage against the cost of the vehicle to determine what the rate of amortization and depreciation is. Now, something that's very important to note, in the year that an asset was purchased, we are only going to claim, or rather expense, half of the total amortization amount. Now, every year after that, we're going to take the full amount that we're allowed. Okay? So that's the method we're going to use, and this is the rate we're going to apply. And now all we need to do is calculate the amount of amortization. And to do that, we're just going to take the cost of the vehicle, the $28,750, and we're going to multiply it by the rate, or the 30%. So here we can see that the total annual amortization or depreciation expense is $8,625. So again, because in the first year we're only going to claim half of that expense, all we need to do is divide that in half. So we'll take the 8625 and we'll divide it by 2. So we'll end up with a total amortization expense of the year of $43,1250. And once we post a journal entry, which I'm going to go through in another tutorial, it would show up on your balance sheet like this if it was posted correctly. Okay, so there's the accumulated amortization in the first year. And then the net book value is simply calculated by the original cost of the truck minus the accumulated amortization. And this would leave us a net book value, or the total net remaining value to be written off, as $24,437.50. Now, just for an example, let's go into year 2. Now, again, using the declining balance method, we will always use the 30% as the rate. However, when we're calculating subsequent years, we will multiply that against what is remaining as the net book value. So we're not going to multiply it against original cost, but rather whatever the remaining balance is. So to calculate our amortization amount for year 2, we will just take the 24,437.50 and multiply it by a rate of 30%, and we have an amount for the second year of depreciation expense of $7,331.25. Now, what's going to happen here in our accumulated amortization, once this second year is posted and you rerun your balance sheet, this account is going to give you a total of the first year amount and the second year amount, so that you then arrive at what the new net book value or the remaining amount of the truck is yet to be expensed. So let's put that in there. We're going to take the 43,1250 and just put some brackets here. It's good you're observing this because we'll be doing Excel as a second part of this course. So that's the first year amortization plus the second year. And because we want a negative value, it's 1. All right, so then the total of our accumulated amortization then after the first year and the second year becomes $11,643.75. And then that brings our net book value, in other words, the amount remaining yet to write off or expense, of $17,106.25. Now, just for demonstration purposes, I'm going to just do one more here and put it as year 3, just to give you another example. So again, the original cost on the balance sheet always remains the same. That never changes. So in year 3, all right, we are going to take, we'll just go up here. We're just simply going to multiply the 30% rate that we're always going to use, but this time we're going to multiply it against the net book value that's remaining, that's $17,106.125. Okay, if you recall, on the second year we multiplied it by this net book value. For the third year, this is what's left remaining, so we're going to multiply the 30% by the $17,106. So for year 3, our amortization charge is $5,131.88. And you'll notice they called it a declining balance method because the balance of this, of the actual vehicle asset continues to decline, as well as the amortization rate. So now what we're going to do is we're going to add this accumulated amortization amount is going to be a total of the amortization depreciation charges that you posted in year 1, year 2, and year 3. So let's see what that looks like. So year 1 again was $43,1250. It should be important to note that you're not going to be adding all this stuff as you post these entries into QuickBooks. It's going to do all the calculations for you. So year 2, we posted $73,31.25. Excuse me, and in year 3, $5,131.88. And because we want a negative value to this equation, we'll put multiplied by -1. Okay, so now in year 3, we have a total accumulated amortization of $16,775.63. And the amount remaining to be expensed, or amortized rather, on the truck, you'll see now is $11,974.37. So when we get into year 4, again, our depreciation expense will be calculated by taking the same 30% rate up here, but now we're going to multiply it against the net book value, or the remaining balance to be expensed against the truck. All right, that concludes this tutorial on how to calculate the amortization and depreciation using a declining balance method. In the next tutorial, I'm going to show you how to actually record these journals in QuickBooks and get into your balance sheet so that you can verify that everything has turned out as expected. See you soon.